All right, let's talk crypto. Is it just a get-rich-quick scheme, or is it actually the future of finance? Today, we're going to cut right through all that noise and give you the playbook that smart investors use to navigate this completely wild market.
So which one is it, really? A revolutionary path to wealth, or just a massive, high-stakes casino? This is the core question, and honestly, the answer depends entirely on your approach. So we're going to guide you through the 4 critical stages of a successful crypto journey, the very things that separate a thoughtful investor from a hopeful gambler.
First up, mapping the market cycles. Because here's the thing. Beneath all the chaotic day-to-day price swings, the crypto market, especially Bitcoin, has this surprisingly predictable rhythm. And learning to read that pattern, that's your foundational first step.
You know the feeling, right? Prices are soaring, headlines are screaming, and everyone is asking the exact same question. Is this a bubble that's about to pop, or are we just at the beginning of the next huge run-up? Well, historical data tells us the answer isn't about guessing. It's about knowing exactly where you are in the market cycle.
Okay, so historically, the Bitcoin market moves in 4 pretty distinct phases. It all starts with accumulation. This is the quiet period, right after the storm, where the really savvy investors get in while prices are low and nobody's excited. Next up is growth, that steady climb back towards the old highs, often kicked into gear by Bitcoin's halving events. Then you get the bubble phase, absolute mania, where prices go vertical and suddenly your cousin is a crypto genius. And finally, the crash, a really painful but predictable correction that in the past has wiped out around 80% from the top, right before the whole cycle starts all over again.
So how can we actually spot these phases? Well, one really powerful clue is looking at how much Bitcoin is just sitting on exchanges. See, when there are high reserves, that means there's a lot of potential selling pressure. But when reserves are low, like this chart shows, it suggests investors are moving their coins into long-term storage. They're holding, not selling. That tightens the supply, it signals huge confidence, and historically, those moments have come right before some really sharp price increases.
Understanding the market's rhythm is one thing, but how do you actually put together a portfolio that can survive these cycles? Well, that brings us to our second section, building a smart portfolio that goes way beyond just buy and hold.
HODL, hold on for dear life. It's the legendary mantra of crypto. But is it always the most effective strategy? The research actually shows that a more active approach, something called rebalancing, can get you better results, especially when it comes to taming this market's absolutely insane volatility. And there are 2 main ways to go about it. The first is time-based rebalancing. This one's simple, it's disciplined. You just adjust your portfolio back to its original targets on a set schedule, like maybe the first of every month. The other path is threshold-based. This is a more responsive approach where you only take action when one of your assets drifts too far from its target, say by 5 or 10%.
And this chart right here shows you exactly why that matters. It compares different strategies using something called the Sharpe ratio, which, to put it simply, just measures how much return you're getting for the amount of risk you're taking. A higher number is better. And as you can see, the passive buy and hold strategy, it had the lowest score. Meanwhile, the 5% threshold strategy performed the best, delivering statistically better returns for the risk involved.
But, and this is a really crucial catch that the researchers themselves point out, every single time you rebalance, you're making a trade, and you're paying transaction fees. So if you do it too often, those little costs can completely eat away at any extra gains you made. The real key is finding that sweet spot between staying disciplined and not just overtrading for the sake of it. Okay, so you've mapped the market, and you have a plan for your portfolio. But in crypto, let's be real, risk is always just around the corner. And that brings us to our critical third section, managing those inevitable risks to protect your capital. Now, it might seem a little ironic to quote a famous crypto skeptic like Warren Buffett, but his #1 rule of investing is more important here than anywhere else. In a market where your assets can drop 50% in a week, survival is literally the name of the game. Protecting your capital isn't just important, it is your first and most important job. And the risks are, well, they're everywhere. You've got the obvious one, the gut-wrenching price volatility. Then there's market manipulation and regulatory uncertainty that can just change the entire game overnight. You've got technological risks like hacks and smart contract bugs. But maybe the most dangerous risk of all is the psychological one, letting FOMO and greed drive your decisions instead of your actual plan. So here's a simple 3-step playbook to protect yourself. First, diversify. Please don't go all in on one coin or one project. Second, use stop-loss orders.
These are automatic triggers to sell if a price falls to a certain level, and they put a hard limit on your potential losses. And third, and this one is absolutely non-negotiable, choose secure, regulated platforms with a proven track record.
So you've navigated the cycles, you've managed your portfolio, and you've protected your assets. You've made a profit? Congratulations! But now comes the crucial final step that so many people overlook, actually keeping what you've earned away from the taxman.
And this, right here, is where things get really tricky. In the world of crypto, and especially in decentralized finance, or DeFi, nearly every single action you take, every swap, every reward, every trade can be a taxable event.
So what is a taxable event? Well, it's any transaction that could trigger a tax liability. In the stock market, this is usually pretty simple. It's just when you sell. But in crypto, oh, it's so much broader. Swapping one coin for another, that's taxable. Buying a coffee with your crypto, taxable. Receiving an airdrop or earning staking rewards, you guessed it, taxable.
Generally speaking, your crypto profits are going to be taxed in one of two ways. Capital gains tax that applies when you sell or trade a crypto asset for a profit. But ordinary income tax applies when you earn crypto through things like airdrops or lending, and it's often taxed at a much higher rate, just like the income from your day job.
And this slide shows how much money you can save just by being patient. For capital gains, the holding period is everything. Sell an asset in under a year, and that's a short-term gain, taxed as ordinary income at rates up to 37%. But if you hold that same asset for just 1 year and 1 day, it becomes a long-term gain, and the tax rates drop dramatically, down to as low as 0% for some people. The difference in your tax bill can be absolutely enormous.
And the world of DeFi is just an absolute minefield of these tax traps. Airdrops are taxed as income the moment you get them. Staking rewards can create this constant stream of tiny taxable transactions that become a total accounting nightmare. Even just moving crypto between your own wallets has to be tracked perfectly. The bottom line is, it gets complicated fast.
So there you have it, the smart investor's 4-part journey. This isn't about just picking the right coin. It's about understanding the market's deep, inherent rhythm, building a disciplined portfolio plan, actively shielding your assets from risk, and finally, paying your dues so you can actually keep what you've earned.
Crypto offers a world of opportunity. There is absolutely no doubt about that. But the real question you have to ask yourself is this: are you prepared to move past the hype and treat this with the seriousness it truly demands? Because in this market, that discipline, that's what makes all the difference.